So what's my strategy for the stock market in 2020? Well, let's get into it. So this question is definitely the one that I get DM'd about the most. Like, what are you going to invest in 2020? What stocks do you think are good right now? And well, I just thought I'd make a video to kind of cover my whole strategy here going into 2020. So I've tried tons of different medication to help with my breathing issues over the last 4 years. And yesterday was the first time ever that some experimental medication actually worked. So, cheers, guys. You know, one of the best things that you can do to actually appreciate the little things in life a little bit more is not being able to breathe for half a decade. So the first thing I want to say about my stock market strategy for 2020 is that, as you guys know, I made a few videos about how the stock market should have gone through the end of its cycle by now, meaning that this is the first time in the history of the world that we have gone 10 years without some sort of stock market, a big correction or recession, well, around the world. So just as I'm going through this video, keep that in mind, that we are in very, very new territory. And just on a little bit more of a personal note is that I know a lot of you guys watch this channel specifically for my stock market investing videos. Even though a lot of you out there think that's kind of like my primary interest, stock market's kind of like a tertiary thing in my life. You know, I like business and real estate more than, hi buddy, more than the stock market stuff. So I'm gonna keep making these stock market-like videos, but I'm at least gonna change them up a little bit to make them a little bit more fun for me to actually make like this. But I do wanna keep you guys updated on my strategies, specifically for this upcoming year, so let's go. So the very first thing I'm going to say about my stock market strategy for 2020 is that, well, it's actually a little bit more of a mindset for this investing period for the next 1 to 2, maybe 1 to 3 years. It's that whatever amount of money you decide to invest or put into a stock, assume that over the next 1.5 years, you're going to lose anywhere between 25 and 50% of it in terms of value of the actual stock. And then assume you'll get a return on it within the next 2 to 3, maybe even 4 years. So I'm not saying that a recession is going to happen or a stock market correction is going to happen within the next 1.5 years, but I'm investing as if I assume a bad one is going to hit. However, this is how you should be investing pretty much anyways. You should never invest more than you are willing to lose. Because what's gonna happen to a lot of rookie stock market investors out there is that you're going to invest whatever, $10,000, $1,000, $5,000 in the market, maybe in the next couple years, there's gonna be some sort of correction that happens where all of a sudden maybe your $10,000 investment becomes $8,000, then you start to panic, you're like, okay, this is not for me, this is my first time investing, you sell your money, or you sell your stock, you take your money out of the market, then that's when you guarantee a $2,000 loss. So then what you're supposed to happen, you're supposed to ride the wave. You're supposed to ride through that dip, that 20, 30, 40% dip in the market. Then you're supposed to come out stronger. If you hold on to your stock, instead of selling when it starts to dip, usually the dip only takes about 1 year, 2 years to go through. You hold on to it for 3, 4, 5 years, you'll start to see not only positive returns, but usually really big returns that most people who get in and out of the market, even during bullish times, that they won't even see. So that's my first tip for investing in the stock market this year, but we got to head to the gym, so give me 1 second. So the second strategy that I have here is kind of similar to the first one, which is I'm going to keep a little bit more cash on hand than normal. So what this means is that if you normally invest again like $1,000, maybe you only invest $800 this time and have $200 on cash. So if there's a slump in the market, or maybe you need some sort of emergency money or expenses that you don't foresee coming, maybe you lose your job, whatever it may be, you have some cash to cover those expenses. And also, yeah, if the market slumps again, then it's what Mark Cuban calls the World Series of investing. Because everything is pretty much 50% off, and you're guaranteed to make money if you buy stocks during a recession. "20 minutes in, I'm already tired." Whew. Whew, that was a good workout. Anyways, I wanted to mention one more thing about cash on hand, actually, and that's this could be both a positive thing and it might be a little bit of a negative thing. Let me give you both sides of the coin here. So I do think that it's positive to have cash on hand, and it might be a good thing because, well, if something bad does happen, you have an opportunity to strike, and also something bad does happen to your investments, it's that you have money to recover and you don't have to sell your stock and take a loss. But if you were to look at every other big investor or just investor in general out there, pretty much all of them have cash on hand and aren't pumping in most of their usual investment dollars into the stock market. And they're kind of waiting for a recession, kind of like I am in a little bit in a sense. So there might actually be more opportunity to invest in good priced stocks out there than you think. Now, I've been looking over stocks recently. It's really tough to find a good deal. I mean, the S&P 500 specifically has just been so crazy over the past couple of years that it's really tough to find a deal, but there are probably deals out there for some stocks because the big investors out there, the big banks, a lot of the middle investors like me are expecting some sort of correction to happen pretty soon, which means that there are investment dollars being left on the table somewhere. It's just maybe you gotta go find them. But I don't know, that's just my opinion. What do you guys think? However, this might also mean because everyone's expecting some sort of bad correction or recession to happen, that maybe when there's just some sort of bad news in the market, maybe the market's down 4% one day, maybe people start taking their money out because they're expecting a recession to happen. Everyone's been hearing the news. Maybe you should take your money out now. It was a good ride over the past couple of years. Maybe they take their money out and the recession is much worse than it should be. And it might happen a lot quicker than it would otherwise if people were not scared. So what do you guys think actually? Do you guys think that you should have some cash on hand like I think you should? Or do you think that you should be all in again for this market? Let me know what you think in the comments down below. So one more thing I wanted to mention about my investing strategy for 2020 is that I'm going to be using part of my stock market for beginners strategy. Whatever stocks I buy in 2020, I plan to hold for 5+ years. And this is kind of a strategy I give for anyone who wants to invest in the stock market themselves. I talk about this a bunch in my investing course. I also mention this in my stock market for beginners tutorial video on YouTube. And the reason why I say this is because the market's going to have its ups and downs and might have more of its downs over the next couple of years. But generally, if you hold a stock for 5 years, regardless of whether a recession happens or not, unless the recession starts at the end of that 5th year of holding your stock, odds are you will have a positive return. And obviously if you hold on to it for 5, 10, 15, 20 years and the company's still around and everything's going pretty well in the economy, you're gonna have some pretty big returns that you'll enjoy. So the next thing I want to talk about in regards to my stock market strategy for 2020 is I want to talk about the companies that I am interested in and what I look for when I'm buying a stock, at least these days. So a lot of people these days, they're putting their money into the S&P 500, specifically in index funds. There's nothing wrong with that, that's really good. And I took a look at the S&P 500 too, but the thing is that because I am assuming some sort of stock market correction or recession is going to happen in the next couple of years, I'm specifically looking at the companies in that S&P 500 that have very good balance sheets. So what does it mean to have a good balance sheet? Well, I'm going to tell you. Having a good balance sheet, first of all, that's one way to put it. Another way to put it is that you want to invest in a company that can take a significant hit to either their profits or their revenue for at least 2 to 3 years and still be fine and still have a fully functioning company, I guess. So there's a few things that you want to look for in regards to a company's financial health and their balance sheets, and can they survive a 2-year downturn in the economy. So I like to look at things like cash. So let's start off with just cash in the bank. So this is probably the biggest determining factor in terms of whether a company can survive a recession. It is how much cash do they have in the bank. And so there's tons of companies out there that have way too much cash in the bank that are just fine. Like you have, people always think about Apple having whatever, hundreds of billions, Google and so on. Those companies, if they were to have a 2-year downturn, they're going to be just fine. That is, unless people stop using Google, people stop using iPhones, then yeah, they're gonna have a bad time after a recession, but that's something outside of the economic environment that we are talking about. So why is cash in the bank so important for companies to look at right now and for 2020? Well, I like to think of it as this. I talk about this with you guys too for your personal finance, is that a recession for a company, it's kind of like being unemployed or going from full-time to part-time. You know, your income gets cut down, and do you have the runway to survive until things pick up for you again? And that's how it is in a recession. When people stop buying things, stop buying products, do you have enough savings to get through until your next job? Again, yeah, that's what it's like. That's what it's like for companies out there. A recession is pretty much like your income being cut down in half, and you're just waiting for the end of the recession to happen so that you can get back to growing and going full board and making as much money as you're supposed to be making. So another thing I want to mention is a pretty significant factor in determining whether a company will be able to do well during a stock market correction or downturn is how much debt the company has. And also, what is the source of debt too? Because typically what happens during a correction is that people and other businesses and companies, they can no longer, some of them, a small percentage, can no longer pay their debt. And all of a sudden, whoever is holding that debt expects a payment. If that happens for enough of their debt, all of a sudden, if they have debt, all of a sudden their cash flow goes down. Maybe they can't pay their debts, maybe they can't pay their employees, and all of a sudden this company is in a lot of trouble. Maybe they have to downsize, maybe they go bankrupt and shut down. Debt is one of the worst things that you can have during a recession. And so now when I look at companies, again, so far we've just mentioned cash in the bank, which is very important to look at if you expect a recession or a correction to happen, and debt. So low debt, a lot of cash in the bank, those are two very important signs that a company will survive a downturn in the stock market. So those are two key variables for you guys to look out for when investing in companies in the next year or so. I do like to look at current cash flow as well. So if you have a high enough cash flow, if you're making good profits, good operating income and so on right now, that's also usually a good sign that you can survive a recession and your company is going to be just fine and continue growing through a recession. So I do like to look at things along those lines as well. Let's see what else. There's also what type of investments are the company making and where is their debt held? So a lot of people don't know this, but giant companies out there, you can name any one of them, any one that's worth $50 billion or more, they usually have giant investments in other companies. And usually the ones that have a diversified investment portfolio, those are the ones that typically do well during a stock market correction. But let's say you have a company that isn't so diversified and maybe they have a big investment in one sector. Let's just say the tech sector in 1990. Maybe one of the banks out there invested pretty much 50% of their portfolio, or 30 or 40% into all the tech companies in the 90s. Well, all of a sudden, that bank, even though they are not a tech company, they invested in the tech bubble, so they're probably going to get hit in terms of their valuation and their investment and their cash flow and so on. And one of the last things I like to look at in regards to companies' kind of balance sheet and financial health is actually what do their assets do? Do they have different avenues for making money? And this can be very vital during a downturn in the economy like a recession. So let's take a company like, let's say Amazon. I talk about them a bunch. They actually have a few really big sources of income. So let's take a company like, let's just say Amazon or something like that. Now, I know you guys hear me talk about Amazon a lot, but here's a decent scenario in terms of why it's important to have multiple different sources of income for even a big company like them. So what typically happens when economic times are not so good is that people stop spending money, they pull money out of their investments, they try to start saving a little bit more. And when money stops circulating like that, that also adds on to the recession, the economic downturn. And so what business would hurt the most if people stopped spending money on things they don't need? Well, that would be something like retail, or now e-commerce. So let's just say Amazon's revenue from its marketplace got cut down by 40% overnight, just 40% overnight. Now, Amazon would probably have a rough go, and they may have to kind of downsize a little bit or restructure part of their company to get by. However, they have Amazon Web Services, which is a company that is completely separate from Amazon Marketplace, which makes profits of tens of billions of dollars. Now, Amazon Web Services might get hit a little bit too, but because it's a completely different industry in a sense, it would help supplement that hit that was taken from the Amazon Marketplace. So when you look at companies, you want to see some sort of diversified income streams in a sense, because that's a good indicator that a company can survive a temporary downturn in the economy. And you know what, I was thinking about this too. I was actually looking over some of the statistics for the S&P 500, and only about 100 of the S&P 500 companies have like really healthy balance sheets where you know that they're going to be good no matter what. And only about another 100 are like, they're solid. 100 other ones have very solid balance sheets where they're going to be good in most scenarios too. But you know, about 200 or 300 are kind of in a limbo place where if there's an economic downturn, they're going to drop out of the S&P 500 potentially if other companies are able to take a lesser hit. So it's actually interesting. Go ahead and you guys look at the balance sheets of the S&P 500 and you'll be able to tell there's some clear indicators of companies that can survive downturns and some that cannot. And and I'm quite interested to see what happens actually if there is to be a temporary recession in the next year or two. So anyways, this is, again, I know I'm focusing really heavy right now on what happens if there is some sort of recession. That's what I'm planning for in 2020. So that brings me to my next point, which is actually, what are the recession-proof stocks? So these are the stocks or companies that actually do okay during recession. Some of them just stay static, which is fantastic, and don't have a lot of growth, and some might actually bump up a little bit. Now, that's rare. Usually what happens, these recession-proof stocks, is instead of experiencing a 20 to 40% downturn in their stock valuation, it might only have a downturn of 5% or 10%, or maybe they stay the same. And so these are the kind of stocks that I like to look at when I expect some sort of economic downturn. So in regards to some recommendations, I guess, in terms of what industries and companies to look for and to look out for, I would say try to, again, stay away from the companies that don't have a lot of cash in the bank and don't have a lot of debt, have some good cash flow. What does that mean to stay away from? Well, it's generally like tech and those kinds of companies. Like the unicorn startup companies like Uber or Lyft or a bunch of those kinds of companies that they rely on investments in order for them to actually get by. Now, when that investment money dries up, like it typically does during an economic downturn, well, you're kind of left in a really bad position where the company either has to shut down or extremely downsize, at least temporarily. So you could lose your entire investment in companies that are not prepared for a revenue or economic downturn. So I guess as a whole, actually, I was trying to think of this. A lot of just new companies in general. I mean, companies that are in the S&P 500 that are 10 years, maybe 15 to 20 years old or less. I mean, the cutoff might actually be Google, like 1998 and before. Those kinds of companies typically have money in the bank. They're typically solid, and the ones that have come after that, usually, I'm saying usually, I know a lot of people out there think that when I say something in the comments down below, I always get like, hey, that's not true, that's not true. I'm just saying, a lot of the times, the newer companies do not have the time to build up that cash in the bank. So as a general rule, newer companies and tech companies really tend to struggle during economic downturns, and companies that have been around for a long time have dealt with these economic downturns before, so they have a proven track record as well to get through things like this. I mean, just look at those kinds of companies I always mention, like Coca-Cola. They've survived every economic downturn for the past 150 years, however long they've been around. Every single one of them, and they've come out even stronger. They're a pretty good track record company that I would bet on for surviving another year and actually growing well into the future. I know I'm trying not to have this video be about an economic collapse, because I know that I talked about that a couple years ago, and we've kind of bucked that trend. But at some point, the boom cycle is going to restart again. We're still in the boom for some reason, and then we're going to go into that bust. It should be relatively soon, but who knows? So I'm just saying, just try to be safe with your money. and avoid as much of the speculation companies and a lot of the companies that don't have proven track records. Avoid them if you can. But if you want to go ahead and place an investment and bet on them, maybe Uber 10x's in valuation over the next 5 years. Maybe they go bankrupt. Who knows? I would bet to the latter, but that's just my opinion. What do you guys think? And you know something else that's kind of funny that I never thought I would mention or talk about for an investment because I'm a young person who doesn't talk about these things. It's actually bonds. I know I took a look at bonds recently, and there's some not so bad deals out there. I've seen some yields between 2 and 3.5% in some cases. Now, the ones with the higher yield, typically more risk. Some are corporations, some are municipal bonds. But I haven't really talked about bonds much, and I don't know how much you guys want me to talk about bonds. But there are some bad deals for bonds out there for sure. I mean, if you're getting a 1 to 1.5%, 2% yield on a bond, I mean, 2% is kind of okay. 2%, it's like you're getting your money back. It's better than putting your money in the bank. But if you're getting 1.5%, like, again, at the end of the day, what are you doing? But I did see some ones that are higher that are not garbage. They're not junk bonds. They're actually okay. I mean, I've seen some Canadian ones. I think that they were at 2% and above for some Canadian bonds, which for government ones, if I'm not mistaken. Thought I saw some 2.5% out there, but I could be wrong. So bonds are something where if you are not sure what you should do with your money, that's a good case. Put your money into US Treasury bonds, Canadian Treasury bonds, your country's Treasury bonds. If you're not 100% sure and it has a positive yield of above 1 to 1.5%, 2%, that's actually a decent thing to do, I would say, at this current second in time. If this was during the hot streak like the S&P 500, that's why I haven't talked about bonds over the past few years, is that it's almost certain that the stock market would outperform the bond market for the past 5 years, and that's been the case. But now the bond market might be the safer place to put your money right now if you're just uncertain of the stock market's future. So I guess hopefully I didn't miss anything here, but I guess a general overview of everything, of my whole strategy for the 2020 is for every $1,000 I would invest, but yeah, again, I'd only invest about 800. So I want to have some cash on hand. I want to be a little bit liquid. Don't want to be leveraged at all. So again, I guess I should talk about that too. I don't usually invest in stocks on margin anyways, but I know a lot of you out there that watch these videos do. You guys like to take out debt to invest in the stock market. I'm not that kind of guy. I really do not like margin calls, and I think now would be a horrible, horrible time to invest in stocks on margin. It's going to get even more volatile over the next little while. So I would just say be wary. Do not take out debt to invest in a company right now. I think that is a very, very dumb idea. So yeah, anyways, I'm investing about 80% of what I would normally invest right now. I'd have a little bit more cash. I'm looking for healthy companies with a track record. So healthy companies with a track record, I already covered that. Healthy balance sheets. Oh, I guess I should also mention too, obviously, because this is the Jack Chappell channel, is that I am still looking for companies with good dividends. In fact, right now, I don't know if I'm invested in a company that doesn't pay a dividend. I'm actually trying to think of one that nope. I'm only invested in companies that are paying dividends right now. And so I like to look at the 3 to 4% yields. Those are really the 3 to 4.5%, usually a sign that a company is healthy and is paying out some of its earnings to its shareholders properly. Usually once you go above 4.5% yield, dividend yield, that's when you have to start looking at why are they paying out more than a 4.5% yield. And usually that's to attract investors and raise the share prices. So when you start seeing 5-6% yields, I know that sometimes AT&T and some telecom companies, and we just lost focus. I know that some AT&T and like telecom companies, they occasionally go above 5%. I don't know if that's the case actually right now, but usually once you get into the above 4.5% yield territory, this company is just trying to raise its share price, so probably don't invest in those right now. So I'm looking at 3 to 4.5% yields. I'm looking at industries that are healthy, typically survive an economic downturn. So I'm looking at banks with good balance sheets, food companies with good balance sheets, branding, like really good brand companies with moats, kind of like the Warren Buffett. It's kind of like my general strategy. I'm trying to think of this actually. Thought of this today. is that my general investing strategy is a mix of Warren Buffett with Kevin O'Leary. So Warren Buffett, he likes to invest in companies that have a good cash flow. They are usually not, I shouldn't even say good cash flow, I would say well-branded companies. They have the capability to make a lot of money, but they are not run that well, and they are undervalued. And so he usually makes one big investment every couple of years, and he'll invest a little bit here, a little bit there. But he likes to look for those kinds of companies, like heavy branding companies that could be run better and are undervalued. And Kevin O'Leary, he's a little bit of the same way, but he likes cash flow and dividends, which is what I like too. And so my strategy is kind of a mix of both. Warren Buffett looks a little bit more about the macro and the non-strict financial parts of companies, and Kevin O'Leary is pretty much strict, looks at the financials of companies. So, I mean, that's the thing about Tesla. Like I was looking at this video recently about him, where Tesla's starting to win him over, where Tesla's actually proven that they can make money now and that there's an end game for them to be a long-term decent company. Even though Tesla's pretty much almost gone bankrupt twice over the past 2 years, I could make a whole video on that. People don't know this. A lot of people don't know this, is that Tesla was almost bankrupt twice again over the last 2 years. They were within a couple weeks of insolvency both times. Actually, Elon talked about one of the scenarios on the Joe Rogan podcast, how he was a week or two again away from insolvency, and or was it on the Joe Rogan podcast? I forget what it was, but Tesla came close to going bankrupt again, and they got away again. They got away by the skin of their teeth again. So, yeah, that whole Tesla rant. Tesla has just proven to be that company that's just kind of gets through everything. It's very strange. There's a lot of perseverance with that company, and I know I rip on them a lot. I also promote them a lot. But again, as I say, I can't invest in Tesla. I cannot do it. They're just so volatile. Their prices go up and down. The company valuation goes up and down. I've seen too much. I can't invest in them. But hey, if Kevin O'Leary wants to, good for him. So what do you guys think is going to happen to the market in 2020, and what are your strategies? So let me know in the comments down below. And if you're interested in some more investing videos, I have tons of playlists and tons of videos about the stock market and some really good strategies. I have whole billionaire strategy videos, investing strategy videos, so please check those out. And please follow me on TikTok and Instagram. I know a lot of you have over the past few days, so thank you very much. I post highlights and clips from these videos on there, so if you just want to see, 5 or 10 seconds of really important facts, please do that. And for now, thank you for watching. I'll see you guys in the next video.